Welcome, PHG family. Today we're going to talk about the new regulations for unrelated business taxable income. IRS issues some new rules that are effective for all exempt organizations. However, clubs, 501c7, have a unique tax treatment on some of the particular components. Today I have with me Courtney Cound, CPA, been with us 2 years, has 12 years plus experience, a graduate from FGCU. Go Eagles!
Go Eagles.
Glad to have you, Courtney.
Thanks for having me.
My name is Nathan Phillips. I'm the managing partner of PHG, and both of us are going to talk about these new rules and the implications, how they affect the club industry, more specifically, the 501c7 tax exempt clubs. So, being prepared because now these new laws take effect for tax years beginning after December 2nd, 2020. Or in essence, any club for 2021 that's a 501c7 club now have to report under these new regulations. Now keep in mind that these new regulations are associated and geared toward non-member income. So you have to take some active participation to help identify some of these things that we're going to talk about. In the previous law, they used to classify non-member income in what we refer to as the NASIC six-digit code, and now it's gone from 6 down to 2, being that North American Industry Classification System. And in the essence of that, or the acronym of that, is NASIC. So now you have a NASIC two-digit code that has to be used to identify all the non-member income streams. So Courtney's going to talk about a couple of these components and things for you to consider, and we'll further have discussions on these items in the future. Podcast 1 today is to talk about a method looking at the income. The next podcast, we're going to do 3 of these. Our second podcast is dealing with deductions and the allocation of expenses. IRS permits 3 methods to be used. First method is gross to gross, a common term you've heard before in previous tax returns and in the industry. The second method, it's going to be the big divot, and we're going to talk about that in our second podcast. And then the third method of that is the actual usage. Then we're going to have a third podcast, and that's to look at the practical application and use templates to help you further the cause of the new tax law for your particular club. So Courtney, share a little bit about some things in regards to the income side, and once again, the non-member impact. That's what we're talking about.
Sure, Nathan. As you had mentioned, the truncated 2-digit NAICS NASIC code for specific non-member income activities is being used for different, what they're referring to as sectors. So there are separate sectors identified for retail trade. So that's things such as your pro shop, your ship store. Then there are rental and real estate activities. If you're renting out a communal room or meeting space, or you have golf cart rentals or club rentals, locker storage, those kinds of things. Then you have educational services, which are, for instance, if you have golf instructors, you have pros that are teaching. Also, a separate sector is for user fees, reciprocal fees. And then finally, there's your F&B activities and your interest and your investment income, some things that we're normally familiar with that we've identified in previous years on your tax returns. So it's, as you had said, it's really important that we identify what these streams are. And if you have not already done so, that you set up your GL or your accounting system, whether that's Jonas or Aloha or whatever system you're using, to identify the specific non-member income. As you had said, Nathan, this is non-member income related.
That's true. And so typically in the past, pro shop income or golf income included everything. And now you're going to actually drill into those income streams and segregate them into these NASIC codes. And like pro shop income, such as rental of the cars, is one area of a digit number. I think it's 53. And then like if you think about lessons that the pros give, that's in a different bucket. And so the allocation of expenses are a big part of that. Now, fortunately, IRS has alluded to and have included payroll as a part of cost of sales, which historically has always been the case. But if you think about it, payroll being at least 50+% of a club, it's advantageous for you to really see where your payroll expenses are by these various buckets of the NASIC codes. So first part of this, for part of income, is to look at your trial balance, general ledger, and look at all your streams of income and put them into those various codes, those 2-digit codes that Courtney's talked about, and identify those in step one.
And essentially, what the IRS is trying to do is identify those separate codes so that they can tax appropriately on those. That's why identifying those income streams is so important, so that we can allocate, as you said, the payroll and those costs against it, so that we're not netting expense numbers that we should not be under the new regulations.
Yeah, IRS has finally decided that they believe that tax exempt clubs should probably have some tax burden. And so now you're segregating out income and have to allocate the expenses based on various methods, which have some limits to it based on the calculations to sort of arrive some kind of income number, if that, or a loss. Somebody will say, well, is there a de minimis rule, Courtney, in that regard?
No, there's no de minimis rule. On the front page of the new 990T that's effective in 2020, there is a $1,000 deduction for any taxable income, but that is considering all income sources, all Schedule A's, which are what these different non-member income activities are reported on. Other than that, there's no de minimis rule.
Yeah, so IRS thought about it. They had commentary on it, and they chose not to give any particular de minimis rule other than the $1,000 that you see on the 990T. But once again, this is non-member income transactions and reciprocals, things of that nature, as well as guest fees. All those things need to be identified. So your first step is to go through and identify all your non-member income and then put them into those 2-digit codes. That's step one. Our podcast number 2 is going to talk about how to allocate the expenses to it based on the methods provided by IRS. Courtney, anything else you'd like to add to this for today?
I don't believe so. Thanks for doing this podcast and steering us all in the right direction.
Well, we're glad that you're part of the PhD team. We're here to help you and help implement these new rules.